Okay, let's be honest. Just hearing the word taxes is enough to make most people's eyes glaze over, right? We kind of dread tax season. But what if I told you that understanding how taxes actually work is one of the biggest cheat codes to building wealth?
And this quote right here, it's everything. We get so focused on our salary, that big number, but the real game is all about how much of that money you get to keep. And learning the rules is how you win. But here's the thing. A huge part of keeping more is making sure you're not tripped up by bad information. And there's one myth out there that's so common, it literally makes people afraid to earn more money. So let's just bust that wide open right now.
All right, first things first. We have got to talk about tax brackets. Getting this wrong can seriously mess with your career decisions, and for no good reason. It is absolutely crucial to get this right.
So, the U.S. uses what's called a progressive tax system. And that word progressive is the key. It does not mean your entire income gets hit with one high rate if you make more money. It means your income is taxed in stages or portions.
You know, the easiest way to picture this is to think of your income filling up a series of buckets. Your first dollars go into the 10% bucket, and only that money is taxed at 10%. Once that one's full, the next dollars you earn spill over into the 12% bucket, and so on and so on. You never ever get punished for earning more. So let's put this to bed once and for all. Getting a raise that bumps you into a new tax bracket is always a good thing. You will always take home more money. That new higher tax rate only applies to the few dollars you earn inside that new bracket, not your whole paycheck. Myth completely busted.
Okay, so now that we've got that sorted, let's talk about the two most powerful tools you have for lowering your tax bill: deductions and credits. And trust me, knowing the difference between these two is absolutely key. At first glance, you might think they sound kind of similar, but oh man, their impact is totally different. A deduction is good. It lowers the amount of your income the government can tax. But a credit? A credit is a superhero. It directly slashes the final amount of tax you owe. Let's just use an example. Okay, let's put some numbers to this. Imagine you made $50,000 this year. That's our starting line. Now, say you've got a $5,000 deduction. What that does is it shrinks your income in the eyes of the government before they even calculate the tax. So, they now only see you as having made $45,000. Pretty cool, right? That's a nice win. A deduction is great, don't get me wrong, but a tax credit, well, a tax credit is the real MVP. It's the undisputed champion because it swoops in at the very end after your tax has already been calculated. So let's just pretend, after all the math is done, your final tax bill, the actual check you have to write, comes out to $3,000. But then, boom, you find out you qualify for a $1,000 tax credit. That literally wipes $1,000 right off the top. Your $3,000 bill is now just $2,000. It is a straight dollar-for-dollar discount. That's why credits are pure gold. All right, we've talked about how you're taxed, and we've talked about how to lower that tax. Now for a really practical choice you have to make every single year. Do you take the standard deduction, or do you itemize? This is the big question for millions of us, and the answer really just depends on your own financial life. The good news is the math is actually pretty simple.
Think of the standard deduction as the easy button. It's a set amount that anybody can take, no paperwork, no questions asked. Simple. Itemizing, on the other hand, is where you list out all your specific deductible expenses one by one. It's a bit more work, sure, but if your list of expenses adds up to more than the standard deduction, then it is absolutely worth the effort. So what kind of things are we talking about here? Well, some of the really common ones are things like mortgage interest if you own a home, the state and local taxes you've paid, gifts to charity, and sometimes even really big medical bills. For a lot of people, this stuff can add up fast. You know, when you're just starting out, the standard deduction is usually the way to go. It's just a better deal. But as your life gets a little more complex, you buy a house, your income goes up, you start giving more to charity, you'll probably hit a tipping point where itemizing suddenly becomes the much smarter move. So let's just totally reframe this whole thing. Once you understand these basic building blocks, how brackets work, the difference between deductions and credits, and your filing options, taxes stop being this scary, confusing thing. They're just another part of your financial plan. A system with rules that you can learn to navigate.
Look, this knowledge isn't just trivia. It's a tool. It empowers you to make smarter choices with your money all year long. So the real question is, what's your first move going to be? Are you going to go check your pay stub? Are you going to look into a retirement account? The power is officially in your hands.